Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, December 22nd, 2023. You know things are going well on Wall Street when the big story this week is a one-day drop in the stock market after surging over the past month. The S&P 500 index began December below 4,600 and is now close to breaking above its all-time high near 4,800 achieved almost 2 years ago. And I have a chart here of the past 2 years of the S&P 500. Way over here on the right is where it is today. And over here on the left, and I'm going to push this out a little so you can see it. There's its peak from a little over 2 years ago. So it's almost there, very close. And by the way, the same holds true for the NASDAQ Composite Index. And here's a chart of the NASDAQ over the past 2 years. It consists mostly of mega cap tech stocks. It's still got a ways to go, but with interest rates on the, well, not on the decline, but certainly no longer on the rise, it should be making up ground quickly. Dow Jones Industrial Average has also actually already set a new high last week, about 10 days ago. So it's not waiting around. Only the Russell 2000 Index, which consists of small cap stocks, has a long way to go to reach a new high. And here's its chart over the past couple of years. And you can see its peak, over here. And that's from November 2021, a little over 2 years ago. It still has more than 10% to go to reach no high, but it could make up that ground quickly now. The Fed appears to be done raising interest rates. And in fact, the final nail in the coffin for rate hikes may have been pounded down this morning when we learned that the Personal Consumption Expenditures Price Index, or PCE, the Fed's favored measure of inflation, fell 0.1% in November and increased 2.6% over the previous 12 months. That's its first monthly decline since April 2020, shortly after the coronavirus pandemic, the outbreak shut down the economy. So here's that PCE report. I put a link to it here in the article, and you can see they break it down here. Over here on the right where I have the cursor is the 0.1% decline. Now, if you exclude food and energy, it actually rose 0.1%, but nevertheless, that's a good number. Fortunately, it's not another pandemic that is driving consumer prices lower this time. A combination of higher interest rates, unobstructed supply chains, and declining energy prices have conspired to push down prices. Not only is that good news for consumers, but those same factors should help most businesses grow earnings in 2024 too. So with inflation out of the way, and the Fed more likely to cut rates in 2024 than raise them, what will Wall Street worry about now? They say the stock market climbs a wall of worry, and a lot of the previous worries now seem to be disappearing. Well, certainly the threat of an economic recession is still in play, since we won't know for several months if the Fed waited too long to stop raising interest rates. And there's always the possibility of a major geopolitical event that might once again scramble supply chains, such as the war in Ukraine, what's happening in the Middle East, the events in the Red Sea in terms of possibly impeding supply chains, maybe for a while. But those threats are always there. However, in about a month, most companies will release their fourth quarter and full year results for 2023, along with guidance for 2024. Those reports will set the tone for the first quarter of next year and determine to what extent Wall Street is ready to reignite the merger and acquisition and initial public offering transactions that have been mostly dormant over the past 2 years. Now, to give you an idea, there were more than 1,000 IPOs in 2021. But once the Fed started raising interest rates, that number fell to less than 200 in each of the following 2 years, 2022 and this year, 2023. At the same time, merger and acquisition transactions, in terms of the dollar volume of all the global M&A transactions, fell below not just below 2 trillion, but below 1.4 trillion, as you see here, over the past 2 years, after exceeding $5 trillion in 2021. Now, 2021's figure, you can argue, was somewhat inflated by the aftermath of the coronavirus pandemic, forcing some companies with weak balance sheets to be, essentially force them into getting acquired or merged with another company. Also, I think a lot of people realized the Fed would have to start raising interest rates, and a lot of emergent M&A activity uses borrowed money. So it makes sense that the last 2 years volume really dropped. So for those reasons, 2021 will be the benchmark used by Wall Street to determine if the stock market has really fully recovered in 2024. And that's this week's PF Update. Everyone have a great Christmas weekend and safe New Year, and I look forward to talking to you another week. Thank you.